Imagine a single financial tool that protects your family and grows your money, tax-free. What if you could secure your loved one's future and build wealth for retirement, a home, or college, all while keeping the IRS at bay? That's the promise of Indexed Universal Life Insurance, or IUL. Most people think insurance is just for when you die, but IULs are different. They combine lifelong protection with a unique way to grow your savings, shielded from taxes and market crashes. IULs are not simple term policies. They're sophisticated tools that can anchor your financial plan. Today I'll break down how they work, the benefits, the risks, and what you need to watch out for. We'll cover how your money grows, how you can access it tax-free, and the pitfalls to avoid. This isn't a sales pitch. It's about giving you the knowledge to take control of your financial future. When you understand your options, you gain power over your money. And with that power, you can build the life you want. Ready to learn how IULs work? Let's dive in. An IUL is, at its core, a life insurance policy with a twist. It pays a tax-free death benefit to your loved ones when you die. But unlike term insurance, an IUL lasts your whole life, as long as you pay the premiums. The real magic? It builds cash value inside the policy. Part of your premium goes to insurance, the rest grows in a special account. This cash value grows tax-deferred, so you don't pay taxes on gains each year. Even better, you can access this money through policy loans. Potentially tax-free. So, you get three big benefits: lifelong protection, a cash value that can grow, and major tax advantages. It's like a Swiss Army knife for your finances. But only if you know how to use it. Used right, it can be a powerful tool. Used wrong, it can be costly. Let's see how the growth engine works. Here's where indexing comes in. The indexed part of IUL means your cash value growth is linked to a stock market index, like the S&P 500. But your money isn't actually invested in the market. You're not buying stocks. Instead, the insurance company credits interest based on how the index performs. If the market goes up, you get credited with a portion of those gains, up to a set limit. If the market drops, you don't lose money. Your worst case is 0% interest for that year. This is called zero is your hero. No gains, but no losses. You trade off huge market returns for steady, protected growth. It's a way to grow your money without risking your principal. Let's look at the rules that control your returns. IULs have three key levers: the cap rate, the floor, and the participation rate. The cap rate is the maximum interest you can earn in a year, no matter how high the market goes. For example, if your cap is 9% and the market jumps 15%, you still only get 9%. The floor is your safety net, usually 0%. If the market tanks, you don't lose money. The participation rate is the percentage of the index's gain you actually get, up to the cap. Some policies give you 100% participation, others less. These features can change over time, so read your contract carefully. The balance of cap, floor, and participation rate determines your real growth potential. Every policy is different, so compare them closely. Remember, you're trading some upside for protection from losses. That's the core of how IULs work. Now let's talk about your investment choices inside an IUL. You have more options than you might think. Most IULs let you choose from several index options, not just the S&P 500. You might see international indices, blended strategies, or even a fixed account with a guaranteed rate. Diversifying across indices can help smooth out returns. The fixed account is a safe harbor, lower returns, but steady and predictable. You can usually reallocate your money once a year, adjusting as your goals or the market changes. Younger policyholders might go aggressive. Those nearing retirement often shift to safety. Active management is key. Don't set it and forget it. Now, a word of warning about bonuses and sweeteners. Some IULs offer bonuses, upfront or after several years, to make the policy look more attractive. But remember, bonuses aren't free. They're often offset by higher fees or lower caps. Upfront bonuses can mean higher surrender charges and long-term costs. Performance bonuses reward you for keeping the policy, but may mask weaker returns. Always compare policies with and without bonuses. Don't be dazzled by a big number. Get detailed illustrations and look at the long-term impact. The bonus is just one piece of a complex puzzle. Now let's talk about accessing your cash. The real power of an IUL is accessing your cash value through policy loans, potentially tax-free. You're not withdrawing your money, you're borrowing against it, using your cash value as collateral. Your money keeps growing, even as you use it. There are fixed and variable loan options, each with pros and cons. In retirement, you can take loans as income, tax-free, as long as the policy stays in force. When you die, any outstanding loans are subtracted from the death benefit. But manage loans carefully. Too much borrowing can cause the policy to lapse and trigger taxes. Used wisely, this is a powerful way to supplement retirement. IULs aren't cheap, and you need to know the cost before you commit. There's a premium load. 5% to 15% of every payment goes to fees, not your cash value. The cost of insurance rises as you age, eating into your returns if you underfund the policy. Administrative fees add up over decades. Surrender charges are steep if you cancel early, often for 10 to 15 years. Most costs are front-loaded, so your cash value may be low or zero in the early years. IULs are a long-term commitment. Plan to fund them for at least 10 to 15 years. If you might need your money soon, this is not the right product. Don't let anyone tell you these are low-cost or short-term solutions. Know what you're paying for and why. Transparency is key. Now, is an IUL right for you? IULs aren't for everyone. They're best for high earners who've maxed out other retirement accounts. If you haven't filled your 401k or Roth IRA, start there. IULs work for those with a long time horizon and the discipline to pay premiums for decades. Don't buy an IUL if you just need simple life insurance. Term is cheaper. Don't expect get-rich-quick returns or stock market performance. If you can't afford the premiums or might stop paying, stay away. The policy must be structured for maximum cash value, not just a big death benefit. Work with an independent advisor, compare multiple policies, and ask tough questions. A well-designed IUL can be a powerful asset. A poorly designed one can drain your finances. Be the manager of your own money. No one will care about it more than you.